Last week we reviewed the impact of longevity, or rather the risk of living too long, on your retirement. Today I want to review another detriment to retirees, and it's not short-term portfolio volatility, but rather the impact of inflation. Now we must understand that compound interest is very positive to your portfolio, but it could also work against you, especially when you're distributing income. You must understand that everything that we need in the future simply gets more expensive. Houses, cars, healthcare, gas, food, etc., clothes, etc. If we need it, it will surely be more expensive. Now, in the last 25 to 30 years, we've experienced a relatively mild inflation, kind of very low. But we can't ignore the fact that, especially recently, that things have gotten way too expensive. Now, what I want to do here is show you how the impact of inflation on your dollars. For example, if you're generating $3,000 a month at a 4% inflation rate, then in 15 years that would mean that we need to generate $5,400 a month in order to buy the same goods and services as you're buying now at $3,000 a month. If we wait 25 years, that would mean that you need to generate $8,000 a month at that time, which will buy again the same goods and services as $3,000 a month is buying today. So as you can see, inflation is extremely problematic to a retiree on a fixed income. Inflation can and will not only affect your portfolio, but will affect your income as well, and you can plan for it. Don't make the mistake many investors and retirees as well as financial advisors do when they project that you'll actually need less money at retirement. Remember, when you're retired, every day is a Saturday. You got a lot more time to play and a lot more time to explore with the world, which means that you will spend more money, not less. Again, no different than longevity. To be a successful investor, you have to balance the devastating risk of inflation, longevity, and the short-term volatility of your portfolio. Many retirees get so focused on the short term, for example, the short-term volatility in the market, that they in effect hold their money hostage. And because of fear of losing money, they put their money into very low yielding investments or a very low yielding portfolio, which again causes problems because it's just not enough return or not enough income to sustain their standard of living. I will inform you that as an expert in retirement distribution planning, there are a few things that we put in place to help you protect your principal as well as your income during your retirement, and we call this the income for life model, or the income for life approach to income planning. Basically, it's a very prudent and responsible and proper approach to income distribution, where it revolves around putting together a plan that uses multiple investments divided over multiple time frames, as well as some income guarantees wrapped into it. The approach is strategically combines shifting the risk and the investments to provide you a better reliability of income, as well as a better ability to manage your emotions at retirement. And yes, we do consider market exposure or exposure to equities, and again, manage that in a very responsible and prudent manner. Remember, folks, I've told you many times, you only get one chance at retirement, and you only get one chance to do it right. So when planning for retirement or planning for those golden years, I think it's much less important to think about how much money you have, but rather more important to think of how you spread it out over your life and make sure that you have enough income and enough inflation-adjusted income so you can continue your standard of living. And don't forget, folks, right here, this link right here, get my book, Dirty Filthy Lies My Broker Taught Me, or 101 Truths to Money and Investing. Enjoy, and I'll see you next time on Financial QB TV.